US, where economy is heading into a recession which is short and shallow.
Silicon Valley Bank is no more.
The global economy is in doldrums. Global bank shares have in fact fallen on Friday, dragging down the global stock market.
On March 10th, the 16th largest bank in the United States, Silicon Valley Bank, faced the second biggest bank failure. A week following this, another regional U.S. bank, Signature Bank, shut down, while First Republic Bank, FRC, obtained support. Credit Suisse evaded a similar fate as it was bought by UBS. Washington Mutual's collapse was the largest among these bank failures, holding $307 billion at the time. In comparison, Silicon Valley Bank held $209 billion. After this news, benchmark share indexes have seen a drop of more than 20%, but what's really concerning is the growing stress in the banking sector, which is now boosting the odds of a U.S. recession within the next 12 months. So, what caused the collapse of SVB? And how does it pose a threat to the global economy? Just as people store their funds in a bank to gain returns, banks also invest their money in diverse areas to generate income. However, they do not invest the entire amount deposited by their customers. They keep a certain amount of cash as a cash reserve, as mandated by the Federal Reserve's reserve ratio. Additionally, there is a statutory liquidity ratio that the Federal Reserve requires banks to follow, which stipulates that a certain percentage of public deposits must be placed in a reserve specified by the Federal Reserve, such as government bonds, gold reserves, or securities. After accounting for these mandatory ratios, banks invest the majority of their remaining funds in various places. But what if all the depositors of the bank want to withdraw all their money from the bank? Then what? The bank will fail. This is known as the bank run. This is precisely what occurred with SVB, a bank that was founded in 1983 and has its headquarters situated in Santa Carla, California. The bank heavily invested in startups, specifically those in the technology industry that was in the venture stage. It provided loans to these companies, and by 2015, the bank had expanded so much that it served 65% of all startups in America, with the tech industry being its biggest customer. The bank's name, Silicon Valley Bank, suited its clientele well, with many Silicon Valley-based technology-based companies banking with it. The bank was unique in that it primarily worked with technology-based startups. By the end of 2022, it was the 16th largest lender in America, holding total assets worth $209 billion. However, despite its success, the bank eventually crashed. The COVID-19 pandemic triggered a series of events that led to the rise of software-based companies. With global lockdowns in place, venture capitalists started investing heavily in these companies, which proved to be successful even during the pandemic. As a result, startups raised a record-breaking $330 billion in America alone in 2021, nearly double the previous year's numbers. With such a huge influx of funds, technology-based startups turned to banks to deposit their money, and Silicon Valley Bank, SVB, emerged as the top choice. In March 2021, the total deposits with SVB were around $124 billion, a significant increase from $62 billion the previous year. This surge in deposits was not seen in other banks, highlighting SVB's popularity among technology-based startups. The bank had a substantial amount of money in the form of customer deposits and decided to use it for further investment. SVB utilized billions of dollars to invest in government bonds and corporate bonds, which is a common practice among banks to generate more profits. Investing in government bonds is considered a relatively safer option. For those who are unfamiliar with bonds, they are issued by large companies or governments in need of funds. When an individual invests in bonds, the money goes to the issuer, who promises to pay interest rates and return the money with interest at the end of the bond period, which is typically around 5 years. When SVB purchased a substantial amount of bonds, the market's interest rates were at a record low of 0% to 0.25%, as per the Federal Reserve of America. Despite the expectations of these rates to remain low, they eventually increased, leading to a decline in the value of the bonds held by SVB. The relationship between bond prices and interest rates is inverse, which means that when interest rates decrease, bond prices increase. However, the longer you hold a bond, the riskier it becomes as interest rates can fluctuate, causing the price and value of the bond to fluctuate as well, leading to potential losses. SVB faced a worst-case scenario when the American government increased interest rates, causing the value of their bonds to plummet and resulting in a significant loss for them. This loss was compounded by a second negative impact, which was even greater. With the increase in interest rates, borrowing loans became more expensive for startups and companies, prompting them to avoid taking loans and instead withdraw money deposited in banks to meet funding requirements. As a result, tech startups in 2022 wanted to withdraw their deposits from SVB to meet financial needs since venture capitalists stopped funding them. This created problems for the bank as multiple withdrawals were requested simultaneously. It is common knowledge that banks do not keep all of the money deposited by their customers. This means that in the event of all the customers wanting to withdraw their money simultaneously, the bank may not have sufficient funds to meet the demand. SVB faced a similar situation where their customers wanted to withdraw their deposits while the funds they had invested were incurring losses. In response, SVB started selling bonds, even at a loss of $1.8 billion, to meet the demands of their customers and avoid a downgrade. The news of the bond sale caused the value of SVB shares to fall by 60%. Upon hearing the news that the bank was facing a financial crisis and had suffered losses worth billions of dollars due to selling its investments, depositors became anxious about their money and quickly rushed to withdraw it. This led to a massive withdrawal of $42 billion in deposits by March 9, as per a regulatory filing in California. The bank's cash balance turned negative by $958 million by the end of the day, and despite attempts to secure collateral from other sources, it failed to do so. Consequently, the regulators shut down the bank as it was unable to fulfill the depositors' demands. The reason for the current market stress following the collapse of SVB is the possibility of its impact spreading. When a bank collapses, there is often fear that other banks and investments might also face similar situations. Even healthy banks do not maintain adequate cash reserves to pay off all depositors in case of a sudden withdrawal of funds, which could result in a widespread financial and economic crisis due to a bank run. Therefore, the Biden administration and the Federal Reserve are working to prevent a financial crisis caused primarily by a sharp decline in confidence. So far, the U.S. Federal Reserve has provided direct support of over $400 billion. The Fed has approved loans to other banks valued at almost $153 billion, which is higher than the previous record of $112 billion during the 2008 crisis. The total amount of money lent by the Fed to the financial system, which is $318 billion, is approximately half of what was extended during the global financial crisis. It is too early to predict if we will face a repeat of the 2008 global financial crisis, but there are some reasons to be optimistic. Firstly, banks are currently in better financial condition as compared to 2008 when they had limited capital to cover losses from the U.S. subprime mortgage market's meltdown. Secondly, unlike in 2008 when the global financial system froze due to uncertainty about losses and bank exposures, there are no signs of such a situation yet. Banks now regularly report on the quality of their asset portfolios and undergo severe stress tests. Finally, central banks like the Federal Reserve and the European Central Bank have established credit lines to assist banks with cash flow issues. Despite this, the global financial crisis began on a small scale and escalated rapidly. It is evident that banks and other financial institutions are still vulnerable to such crises.